From following information, you are required to calculate weighted average time period for which investment is made in following securities, ignoring time value of money concept. That is the question. There are two securities provided to us. It is zero coupon bond. It means that there is no intermediate cash flow. Face value is given 1 lakh, 9 lakhs. Time period is given 2 years and 10 years. And you are required to make the computation of the weighted average time period for which investment to be made in following securities. Let us have understanding that how to make the calculation of answer. Students are requested to pay attention. Now friends, before we calculate answer of this question, something like a new concept that we are going to discuss, I want to explain that to you. The new concept is something like this. We understand that whenever an investor is making investment in fixed income securities, whenever an investor is making investment in fixed income securities, then in that case, always there is a risk called interest rate risk. It means that suppose the time period for which you are going to make investment is 10 years. In a security wherein you are going to get the interest income which is annually same, that is an amount of rupees 1000. Redemption value of the security is rupees 10,000. And considering the investors required rate of return, there is a price at which investor has made investment. The rate of interest is, let us say, 10%. Now, once you block your funds for a time period of 10 years, then what will happen? There is a risk to you as an investor that after 3 years, it may happen that the rate of interest is increasing in the market. And for the remaining time period, you are required to sacrifice for comparatively lower rate of return. Of course, you will get a return, but comparatively it will be less. That is the kind of risk that you have as an investor when you make investment in a security. Listen carefully. Second thing that we understand is this. Considering that in the market, the rate of interest is likely to go up. Suppose you make investment in securities, which is having the shorter duration. Of course, we know that there are different duration or the different time period for which the securities are available in the market. You are expecting that the rate of interest is likely to go up. Then in that case, you make investment in securities which have the lower time period of the redemption. But instead of increasing in the rate of interest, it may happen that the rate of interest is decreasing in the market. Then in that case, again you will have a problem. Again you will have an issue that you are required to reinvest the amount that you have received at comparatively lower rate of return. And this is what we understand is the kind of risk that you have as an investor when you make investment in fixed income securities. Listen carefully what I am going to speak further. Considering that at a particular point of time, let us say that 5 years from now, you require an amount of rupees 10 lakhs. Considering the current market rate of interest, you make an investment of an amount of the funds today. Taking into account the current market situation, you make investment in a security for in amount, so that at the end of the fifth year you get an amount of 10 lakhs. Now this security is such in which intermediate also you are going to receive the cash accrual. Let us say it is debenture. So you are going to get over here interest in the first year, second year, third year, fourth year, and so you are going to compound all these cash accrual at the end of the fifth year, and at the end of the fifth year you are going to get an amount of 10 lakhs. But it may happen like this, that the rate of interest in the market is comparatively less than what you had thought of. Then in that case again you have a risk as an investor. So this is the kind of risk that you have as an investor when you make investment in the fixed income securities. So far we have discussed say two kinds of issues. One is that say you block your funds for longer time period and rate of interest slash capitalization rate increases in market. Second, you require a specific amount of funds, comma, in that case you make investment considering capitalization rate will be equal to some rate, in a way that so you make that is anticipation, that so the rate will be like this and you make investment. However, actual rate of interest, or we understand that so the capitalization rate may fall down. So it may happen that say actually the rate of interest could be less than what you had anticipated. So these are the practical issues that say you would be having. So how you should make investment, that we are going to understand say by using a concept, and that concept is given a name as duration. Duration is a concept which will help us to take this decision. That decision we will take like this. Listen me carefully. If at all you are expecting the rate of interest or the capitalization rate to go up, then in that case how you should invest. If you are expecting it to go down, how you should expect. If at all you require a specific amount of the funds at a certain point of time, then in that case how you should make investment, so that say whether the rate of interest is going up in the market or it is going down in the market, you will be able to get the funds as you desire. That is what say we are going to understand, and that concept is given a name as duration. Apart from this, listen carefully, apart from this, the duration concept will help us to measure approximately what would be the percentage change in P0 for every 1% change in cost of capital. So if at all the market capitalization rate changes, then in that case what is the rate at which the price of the security will change, that you will be able to measure by applying the concept of duration, that is an extended version of the duration which is given as modified duration, and that is what say we are going to understand say over here. I'm just giving explanation to you by taking some numerical values. From following information you are required to calculate, like there is first question, then we have been provided with the information about the calculate the volatility of the security. Now what is the volatility of the security? Volatility of the security is indicating what would be the percentage change in the price of the security for every 1% change in the cost of capital. That is what the volatility is indicating. What we have observed in this question, friends, the one of the earlier question that we did, we have been provided with the rate of interest 10, 18 and 28. The question says that you are required to calculate the current price of the security. Then the question says that if investors required rate of return is 30 instead of 25, then in that case calculate the revise the market price of the security. Explain the change in the price of the security due to change in investors required rate of return. So over there we have written, friends, that's the cost of capital and price of the security have inverse relationship. In a way that's with the increase in the cost of capital, price of the security will decrease and vice versa. Now this concept of the duration will help us to calculate the volatility. Now what is the use of the volatility? It will measure that, say if at all the investors required rate of return increases, then what would be the rate at which the price will decline? If at all the investors required rate of return decreases, then what is the rate at which the price will increase? That you will be able to measure by using the concept of the duration. Later on we are going to see a question like this. We have been provided with the information about the two securities X and Y. The rate of interest information is provided to us. The redemption value information is given. The question says that calculate the duration and volatility of each of the security. So the duration is, like, what is duration? Duration in a simple language, it is the weighted average time period for which the investment is made. Based on that, so you can compute the volatility. So what is volatility? That will measure the percentage change in price of the security for every 1% change in the cost of capital. Now here is what's the thing which we are going to implement by using the duration concept. Which security an investor should purchase if it is expected that capitalization rate of the investor is likely to remain unchanged, if it is likely to increase, if it is likely to fall down. So we are required to make the computation that, say if at all you are expecting the capitalization rate to change, then in that case in which kind of security you should make investment. Because apparently what happens at, say we take decision by using the yield, what is the return, but apart from that, say there is an additional concept that, say if at all you are expecting the rate to fluctuate, then in that case how you should make the investment. And that is what, say we are going to take the decision by using the concept of duration. Let us see now. Coming back to the question, from following information you are required to calculate weighted average time period for which investment is made in following securities. This weighted average time period for which the investment is made is nothing else but it is duration. The question says that, say ignore time value of money concept. There are two securities in which the investor has made investment, zero coupon bond A and zero coupon bond B. We have been provided with the face value of the security information. We understand that, say in case of zero coupon bond, redemption value of the security is equal to the face value, and that is the only cash inflow that you have. Time period is 2 years and 10 years, and for both the time period we are required to, that is, say for both the securities we are required to make the computation of the weighted average time period for which the investment is made. So we understand, let's say, duration of portfolio in bracket I'm writing ignoring time value of money concept. Let us see, let's say, how to do answer. There are two securities in which investment is made, security A and security B. The amount that say you are going to receive, it is 2 lakhs and 1 lakh and 9 lakhs. 1 lakh and 9 lakhs. So the total amount that you are going to receive is 10 lakhs. We can add both of them. Why? Because we have to ignore time value of money. We'll compute the weight slash proportion. So 1 lakh out of 10 lakhs. So that comes to 10%. 9 lakh out of 10 lakhs. That comes to 90%. Time period. We understand that say the funds of the investor is blocked in security A for 2 years and is blocked in security B for 10 years. So it is weight into time period. So it is 2 into 0.10, that comes to 0.2 year, and 0.9 into 10, that comes to 9 years. So weighted average time period for which funds of the investor is blocked is 9.2 years. Please write an answer. Please write down with paragraph. In case of zero coupon bond, comma, there is no cash accrual in between, full stop. Over here, redemption value of security will be cash inflow to investor, full stop. Make this as first point, write on second point. Weighted average time period of investment means duration of investment, full stop. Duration is calculated taking into account amount of cash and time period at which it is going to be received. Full stop. Third point, duration is helpful in A. Measuring volatility of security slash investment. B. Decision making in a situation comma when capitalization rate is likely to change in future. In bracket write down increase or decrease. C. Immunization with paragraph write down. Volatility means finding percentage change in price of security for every 1% change in cost of capital. Full stop. Immunization means such portfolio formulation so that at a particular point of time amount of cash accrual is equal to a specific requirement of funds. Full stop. In bracket write down even though there is a change in capitalization rate in between bracket over.